All right. Um, next up, the market's been under this overhang, which you and I have been talking about now for weeks, and because Liberation Day, which is my favorite, I love when the government names a thing, and when the government names a thing, is usually the thing that whatever the bill or whatever the project or whatever says on the tin, the opposite is actually what's happening. So this idea of Liberation Day, and what do you get for Liberation Day? Tariffs, more and more tariffs,
More
and
tariffs.
so
This time targeted at the auto industry. I don't know if you saw. I mean, a big portion of that pullback was definitely in GM and Ford, seemingly taking some of the biggest hits. I had pulled up a chart here of some of the comparisons of some of the bigger automakers, and just looking at the last 5 days here. Well, let's look at the last like 3 months or so. You can kind of see most of these pulling back pretty sharply just today alone, as many of them were actually starting to gain some traction. So auto industry not looking good at this point. Even Tesla pulled back a bit today as well.
right. I always love that Tesla's been had their bounce, but what all right, I'm not gonna get political. I just find it very funny when the oligarch who's standing next to the soon to be king, his stock is going up. Well, the industry is going down. Fine, whatever. What I find interesting here, so the tariffs are not just on the auto
Hmm.
coming up for April 2nd and April 3rd. We have the auto tariffs, which are big, 25%. We have Venezuelan oil and gas,
Hmm.
so 25% there. Canada and Mexico, 25%. Retaliatory tariffs to the EU. It could scale depending on what they're doing, because he wants to match their tariffs. So just like all over the place, agricultural products, just all over the place tariffs.
Yep.
But at the same time, he's saying, but if we make a deal, then maybe the tariffs don't go on, or maybe we take them off, or maybe it won't be as much. And so, what is this, everyone? This is uncertainty, and uncertainty in markets is volatility. And so, we're seeing that within the overhang, where a bunch of people are like, "Hey, look, let's just withdraw our money from the stock market. Just wait until the dust settles and see what happens." Which, ironically, is exactly the type of catalyst that can actually start a massive
A
drawdown.
sell off for sure.
Yeah.
Yeah, I would say if you're looking for other areas to see some strength, at least my takeaway from this is that obviously stocks with exposure to other countries as far as their revenue are going to be hit a little bit harder, right? The any of the technology, materials, and energy sectors are of course going to be pretty vulnerable. Anything targeting aluminum, steel, that totally makes sense. The defensive stocks are probably going to outperform any of the retail cyclicals. But the one I found, kind of interesting that is worth taking a look at is just really kind of honing in on the software, cybersecurity, defense tech, the large cap financials, because the service industries are obviously going to be the least impacted by a lot of this volatility. So, like one of the sector ETFs that I've been noticing looking pretty good in my portfolio is XLF, which is the finance or the financial sector ETF.
Well, that AI over, because we had the deep seek dip that happened, and then the AI stocks never really recovered after that, because we went right into the heels of this window of weakness from February 20th,
Hmm.
where this drawdown. And one of the unfortunate casualties of this was CoreWeave. This is a stock that you brought up, which is this AI play, infrastructure AI play, and they IPO'd, and let me just pull up my chart here. They IPO'd, and they were expecting like a huge, like a way bigger start.
Hmm.
They're here at $40 per share, but they were expecting way more than that. And it was sad because, well, sad for them, because they've been on this, apparently this massive run in the private money space. I think they did like 700% increase in revenue over the last few years, as they've been ramping up.
Hmm.
And I'm not going to play it now, but the CEO was on the news talking about it, and it was like one of the saddest IPO CEOs I've ever seen, who was expecting this huge, I'm a hero for getting this deal done, and it gets done exactly at the wrong time. So that's pretty painful. But I wanted to bring up here the idea here. You mentioned at the top of the show the 200-day moving average. Now,
Yep.
I'm having difficulty understanding why so many people follow the 200-day moving average. I get as a general general rule, like a general moving average, but many times like the price will crisscross around it. And I know specifically some people who will swear by the 200-day moving average.
Hmm.
Am I missing something there, like versus the 50, the 100, the 300? Like, what's special about the 200?
Sure. Why 200 versus 252, for example? There's 252 trading days in a year. Why not incorporate the entire last year? I
Right.
think a lot of this is just sort of an artifact of the technical analysis community from the 1980s and 90s that had 50, 100, and 200 day indicators that were usually added to their screen. A longer term average is considered a little bit more of a smooth average over a longer period of time, so it gives you a better indication of where price is over that period of time. Obviously there's more noise in a short-term indicator, but you're right. I think the reason that I keep an eye on it is because it is commonly used by many Wall Street analysts. It seems to be
I
a
see.
a common rubric, so it seems to make sense to pay attention to if we're all paying attention to it.
Well, because what you since you put me on VWAP, and I know I keep singing your praises for this, but it completely changed my completely changed my trading. So over here, the we had this VWAP level, this previous VWAP level, that the price just literally retraced from one VWAP to the next one. And but we had missed, we didn't mitigate these two levels from below.
Hmm.
And so my expectation is always that at some, if we were going to turn down, that we had to head towards these two levels before we could even call the end of this this correction phase. So my question now is that one, we closed at the lows of the day. So it's 422. We closed at the lows of the day. Generally speaking, I didn't run the numbers on this, but generally speaking, if the stock market closes on the lows of the day, the selling is not done, and we're going to start the next business day with more selling. But the next level that I have here is at 52.75. Are you seeing anything fib wise or anything like that, Elliott weight wise, that would suggest that we have more selling to do all the way down to that level, or is that just too much to ask for?
I mean, honestly, if we look at my screen here for a
Yeah.
second, there's a couple of differences here. You've got a little bit higher of a close against the 200-day moving average because you're looking at the S&P 500 futures.
Right.
The price is slightly different on the SPX index or even the SPY ETF. And that 200-day moving average, we actually ended up with a tiny little doji that was a close above the 200 before we actually pulled back. So really, the just looking at this chart, this is obviously a pullback against the 200-day moving average, which was sort of my short-term expectation, is that we would test that level and then could potentially pull back against it. And
I
that's
see.
what ended up happening. What I find interesting, though, is that if I'm looking at the fib retrace over this longer period of time from August of 2024, we actually barely touched the 0618 level, which is where I would expect a retrace to kind of end. We got some confirmation to the upside, and we still have ultimately posted a higher low. So if we find support from here, this could still ultimately be the support zone that I think people are hoping for as we move into the April 2nd deadline here. And I know we're going to cover this in a moment. Tom Lee's got some thoughts on how this could still be a rally point. I think there's still room to support the idea that this is a good opportunity to start buying into this zone, and we may not see continued downside from here.
Now, I don't follow Tom Lee as religiously as some other people do, but I do find that he gets to articulate, at least in this case, the bull case, in a way that's fair to the thesis.
So
Here we
that was
go.
interesting to me, Tom Lee, as I bring you into this conversation, the head of research at Fundstrat and a CNBC contributor, because he's talking about animals in hibernation, not animals dying. It goes back to this idea of uncertainty around things like trade and tariff policy.
I would just like to make this comment that this whole Alan Greenspan animal spirits thing that's been around since the 90s, I'm so over with.
We need
When
a
he
new
first started in the
analogy.
markets, sorry.
We need a new analogy.
Yeah, because it's not
Yeah,
even very specific. You get into the
right.
markets, like, what are you talking about, animal spirits? And you got to go learn about the .com bubble before you even understand what's going on. Whatever. And they're really belaboring the point here.
And the fact that as of right now, in the midst of that uncertainty, perhaps companies are sitting on their hands before they start to make any kind of future investments. So if that's the situation, how much does getting some sort of certainty now frame the investment thesis for how you position yourself moving forward?
I think that's exactly what's happening now, Morgan. First, in 2018, which Michael was talking about, the spike in the VIX or the collapse in investor sentiment or consumer confidence, that all happened around February 2018. So really that coincided with that first low that was made in 2018, and the market began to stage its recovery. I don't blame any business or investor for saying, look, there's so much uncertainty, I can't make a decision. I think that's why Rick Reeder's talking about animals in hibernation. But as we start to think about the second half of this year, first of all, we've already had the collapse in sentiment. We've seen $850 billion of cash raised over the past year on money market balances. And then in the second half, we're looking for possibly tax reform, which really propelled stocks in 2017. So I think that the odds of a V-shaped recovery in stocks that come after April 2 is just extremely high because we've already.
So this is something that we've talked about multiple times, that we don't really, it's not very easy for us to get these 5-year, 10-year bear markets. That oftentimes sharp drops within the market are responded to with sharp rises because of how dealer positioning and gamma. And so he's making the case here that after this uncertainty of the tariff thing is gone, April 2nd, April 3rd, well, there's no real reason why we might not rocket back up with a V-shaped recovery because all the negative sentiment has been priced in.
Right. Yep, I agree.
So let's see what he says here. Finish it off.
Already sequenced a lot of the panic that people saw in 2018. I think it's already taken place.
So what would you be buying right now?
Well, to us, I think Exhibit A for a V-shaped recovery is going to be Tesla because it's really been one of the most controversial stocks, and it's been caught in that sort of political maelstrom of Doge and Elon Musk's involvement in the White House. And I think it's already recovered more than 15%. But I think if Tesla is leading us into this bounce, that's a bull case for Mag 7 to be the group to own in the next few months.
So you like Mag?
Yeah. So that Mag 7 bet, I actually really like. I was taking a look at the options for that, and on XLK, actually, you get the same sort of payout on the Qs, but on XLK, the 240 call for June 20. June 2025. Again, I think we peak in June, July, and we roll over. But getting the option in July is a little bit too expensive, and I'd rather get it before the FOMC meeting in the summer. So June, that has a return profile of anywhere between 2 and 10x for the calls, which is pretty good. So you get this exposure to the tech, to the Mag 7, without actually placing your full capital on the stocks themselves, because you never know like when the recession will start, what kind of volatility will be there, blah blah blah. You get exposure to the upside with this asymmetrical play. So if you actually think you can do like 5x on that, 10x on that, well then you only need to put on 1/5 of your position, which would be like your stop, right? The premium is like that would have been my stop anyway if I was going to buy the underlying.
Right.
So I find that interesting. Kem was so right. I was pulling up this video from let me just play it real quick because I never get tired of how right he is. This is a month ago. Okay, a month ago, Kem Carson was talking about this, where from February 20th, we have the sell-off. Let me just jump to it here.
Back to on the vol and the timing and stuff. How long this window of weakness? How deep? And is this a process you see as being a gradual?
So this is like February 20th or whatever. February 19th, February 20th, I believe.
One, or are we in like crash risk?
So right now, to be very clear, this is the beginning of a window of weakness and a correction. I do not see this as a current 20% decline.
Okay.
We've been very clear. We highlighted this many months ago that starting in around February options expiration, we would get 10 to 12% decline. Right? I still think that's the case. It's very orchestrated, controlled. Entities were prepared for it. Again, we talked about all the people. The communication's been clear. The administration's been pretty clear. Here it comes. But just as clear will be a response with QE, right? On the other side, monetary-driven policy.
You think that's what, Q3? When does that happen?
No, that happens sooner.
Yeah?
That happens sooner.
Okay.
I believe that happens probably in the next 3 months.
Do you still think this year we get 6% 10-year, or are these things going to actually work to some effect to bring that
Well,
down?
you know, last year, if you remember, we called for 5, and
Right.
we got it about
Okay, and then he talks about how bonds are going to go to 5%. So
Interesting.
the-
He's wearing an AWS jacket. I wonder,
it's
is that some product placement? What's going on here?
exactly stylish too. Jesus.
Yeah.
But that's like how everyone now is wearing. Not everyone, but a bunch of people, especially my son's generation, have the '70s mustache. It's all back now. It's all the rage. I was like, what are we doing? I thought we decided this was terrible. Anyways,
The tinted glasses are coming back too. I thought about getting a pair of my own.
Okay, that I might actually do. So he talks about here that the path he was sort of laying out is that we get this drawdown in February, and then the drawdown causes some sort of response, either fiscally or monetarily, which then leads to this V up. Here's the little pinch we don't have over here. This drawdown didn't happen enough before the Fed meeting in March to warrant any move from the Fed. And so if that's the case for why we should then bounce back up, if that's crucial to it, we didn't get that. So I wonder if then there's more downside that needs to happen so that the Fed has to come out and, you know, jawbone the markets back up, promising the more liquidity, and then we get to move up. So we didn't get that yet. So to me, this weekend is like the crucial weekend to see what actually happened, what we can expect to see on Monday or Tuesday, once the selling is done, because Bitcoin will tell us if the selling is going to continue into Monday. I mean, generally speaking, it does continue into Monday, and then futures on Sunday will open up, and we'll get a better idea of what's going on in the overnight. So until we get to next Tuesday, I don't think we're in the all clear, and I don't see why we couldn't get a sudden 4-5% down in the S&P and Nasdaq. Just drop. It really washes all the worry out, and then we move up to the right. But I know last week you were talking about that your window for potential bottoming in the market is still like for like the few weeks into April, like the whole month of April. What was your window, your time frame on that?
Yeah, I think we had discussed that being about April into May, and we could pull back as far as, you know, roughly the 520 to 540 line on SPY, or 5200 to 5400.
Yeah,
It
so
still seems probable, but it depends. This next week could spell a very different picture.
That's right. So that's why I think it's crucial for what happens. I'm going to be paying attention to Bitcoin all weekend, and I'll let me know. TradersPost is an automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspost.io and see how easy it is to streamline your trading. TradersPost, because your strategy deserves to run at full speed.